Good day, my name is Omri Thomas, the fund manager of the Nedgroup Investments Opportunity Fund. And what I'd like to do today is just take you through the first quarter, reflect on performance over the first quarter and over the last year, and then just give an outlook on what we see in the markets and how the fund is positioned relative to that market. So if we reflect on what's happened in the last quarter, global inflation rates have been coming down, but more recently they've been becoming a bit more sticky. And the narrative of inflation just continued to drop is now the bond market's not believing that. They've started taking notice of the sticky inflation. You can see it more recently. Bond yields have also sold off a bit. If you look at the US equity market, the market valuation, this is on our valuation model, looks quite full relative to history and relative to a fair value given where interest rates are. Whereas if you look at the South African valuation, that is currently quite cheap, and we know that the South African market's been under quite a bit of pressure, especially if you strip the market from commodities and the rest of the market. Commodities have been doing reasonably well, whereas the rest of the market have been continued to be under pressure. If we look at the interest rate environment, limited rate cuts priced in somewhere between 75 and 100 basis points, which won't provide significant support to the markets, but that we'll probably follow what happens in the US. More recently, we've seen the SA government bonds, the long-dated bonds, selling off again. Now, one has to question the Reserve Bank governor is looking at maybe introducing a low inflation target, and we've already got very high real yields. So it'll be interesting to see what happens if that gets introduced, and that could be provide some support to our long-term bonds. China, we've had exposure to China, as you know, that continues to be extremely attractively valued. You can see on the right-hand side just how the Chinese PE premium has become a significant discount to the MSCI All World Index. And on the left-hand side, you can just see the quantum of the move relative to the all-time highs of the Chinese index. So we think there's significant value in China. So despite it detracting from performance over the last 3 and 12 months, we continue to believe there's a nice value to be had there. Looking at the fund performance, the last 3 months and 1 year has been a tough performance period. A couple of things to notice. If you go back to the start of 2023, we just came off the back of 2 very good years. At that point in time, there was a lot of macro uncertainty as whether it's going to be a hard landing, a soft landing, or if there's going to be a global recession. So there were a lot of macro risks, and we saw a significant value elsewhere in yielding instruments not to have to take that much risk. So we reduced our offshore equity initially, and we also increased our sort of local exposure where we saw more value. Now, with hindsight, they've navigated the US Federal Reserve navigated the difficult conditions quite successfully, and they avoided the landing completely. I mean, the plane's still up in the air. So our conservative positioning and our lowering of our offshore equity exposure didn't help. Secondly, within global equities, we prefer China over US, and if you look at that relative performance, that just got further stretched. Chinese equities underperforming US equities. And then locally, our bonds not really having the best year. So even though it looks like the performance wasn't great, we think the fund was quite conservatively positioned. If we look at the way the fund is now, it's offering a yield of over 8% at this point in time, a running yield with exposure to growth assets and some yielding assets. So if you get a bit of recovery in some of the growth assets, we think one can get a decent return. The longer term performance numbers still look reasonable, but we have to fix the short term performance. That's not great over the last year. Just looking at the attribution, I'm not going to go into too much detail. The detail is in the note, but what has helped is our ABAX Global Equity exposure. It was too small. Inflation linkers, we've added to our inflation linkers, which have also aided performance. And then on the detracting from performance, long bond exposures, as I said, sold off, and also Sasol having quite a torrid time over the last quarter and year. So if we look at the market outlook for the rest of the year, inflation, as I said, sticky and probably above average compared to the history. So the narrative of just seeing continued interest rate cuts globally is, I think, there's some doubt on that, and we think global rate cuts are currently being priced into the market. The tight US labour market is keeping pressure on inflation, but despite that, the Nasdaq and the S&P trading at close to all-time highs. So we remained wary of the US markets. Chinese stocks more recently have started picking up their heads, so that's encouraging, and we hope for that to continue. You're getting a high cash rates locally and globally, so that provides a nice underpin to your portfolio. As I said, we expect about 75 to 100 basis points rate cuts locally, and in SA equities we do find quite a bit of value, and I'll show you some of the recent additions to the fund. SA bonds continue to offer very attractive real returns, and the opportunity yield currently 8.3%. So just look at the asset classes. Most SA asset classes we think offer value. We still think emerging market equities, especially China, offers value. We think the rand is close to fair value given the uncertainties surrounding the election as well. That's a double-edged sword. It could have a very positive impact on the market if there's a coalition between the ANC and some of the, let's call it the parties more on the centrist that's got a centrist view. But if it's a coalition with the far left, the EFF, that will be taken very negative by the market. We think expensive on the expensive side, US equities and developed market bonds. So looking at our fund positioning, and I just contrast that to where we were this time middle last year. As I said, SA equities offering value. We've increased our SA equities significantly, and we've also increased our bonds slightly. It's been funded from SA cash, which we've completely utilized our cash, and we've also increased our offshore equity exposure, more specifically, mostly in Chinese equities, whilst reducing our offshore bond exposure as well. Our top 10 equity positions, we've increased our APSA weighting. It's currently 4% of the portfolio. APSA currently yielding 10% with a PE of below 6 times. We still expect earnings growth from APSA. They've got one of the highest credit loss provision ratios within the sector. So we think it's quite conservative balance sheet. And if you think a 10% dividend yield plus call it 3 to 5% earnings growth, that already gives you a 15% return. And if there's some re-rating from the 5.5 times PE, you could easily see a 20% plus return from APSA. So we think it's quite attractive. And it's not only APSA, that the whole banking sector actually looks interesting. We sold out of FirstRand completely, and at the lower levels we've bought back. You'll see this 1.5% stake in FirstRand as well. Sasol, it's a low quality company. But at these levels, with the rand oil prices and with chemical prices starting to recover at a 4 times PE, we think it's very attractively valued and provides you with a bit of a hedge against macro uncertainty as well. Auto Home is the Chinese We Buy Cars. The market cap is less than the cash that they've got on the balance sheet. It's got an 8% dividend yield. They're buying back shares. So one of those Chinese shares, very attractively valued. British American Tobacco, which owns a big slug of India Tobacco Company. If you strip that out, the rump PE is below 5 times. And more recently, they've initiated share buybacks. So we're quite excited about the potential total return that you're getting from British American Tobacco. A dividend yield of 10%, a PE of below 5 times, plus they're buying back shares. We've got 2 fintech companies, TBC Bank, it's a Georgian a bank that's got a very high ROE and a low cost to income ratio. They're exposed to a fast-growing Georgian economy with inflation under control. They've got good management team, so it's done very well for the fund, but we expect further growth from them. Naspers process, we sold completely out of Naspers process, and into the December sell-off, we picked up exposure again. So our timing of our purchase there was quite good. And again, there's a Tencent has been weak, but it also more recently looks like it's lifting its head. So we think there's a bit more room to go there. And then MTN, that's been under pressure because of the pressure on the Nigerian currency and their inability to extract cash from the African operations. It's an attractive dividend yield, and there's some value unlock opportunities, but we caution ourselves to not increase our position too large because of all these uncertainties. It's a difficult position that they're in at the moment. And then QFin, a Chinese fintech company, also at very attractive valuations, and Alibaba, it's a very attractive entry into a great Chinese platform business. With that, I thank you, and hopefully we can improve on our performance over the next 12 months.